This is the Chicks of FinTwit, a finance podcast by women for everyone. I am your host, Caitlin Cook. Join me as I highlight female trailblazers and their male allies across the industry as each shares their expertise on a variety of finance topics. Nothing is off limits. Thanks for joining us. Now please enjoy this episode.
All opinions expressed by Caitlin Cook and the Chicks of FinTwit podcast guests are solely their own opinions and do not reflect the opinions of the host or any of their affiliates. This podcast is for informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities, nor is this an offer or sale of a security.
Hello, and welcome to the Chicks of FinTwit podcast, a finance podcast by women for everyone. I am your host, Caitlin Cook, otherwise known as Dead Kate Bounce on Twitter. And today with us, we have Lauren Templeton. Lauren is the founder and president of Templeton and Phillips Capital Management. Lauren received a bachelor's degree in economics from the University of the South and currently serves on the Board of Trustees at the Baylor School. She is also independent director for Fairfax Financial Holdings Limited, Fairfax India Holdings Corporation, and Canadian Solar. Lauren is the great niece of Sir John M. Templeton and is a current member of the John M. Templeton Foundation, the Templeton World Charities Foundation, and a trustee of Templeton Religion Trust. Professionally speaking, Lauren began her career working with managed portfolios and investments in 1998, beginning as a junior associate at the financial advisor Homrich and Berg, and later the hedge fund management company New Providence Advisors, both of Atlanta, Georgia. In 2001, Lauren founded Templeton Capital Management with seed capital from Sir John Templeton in a long-short equity hedge fund. That same year, Lauren was the founder and president of the Southeastern Hedge Fund Association based in Atlanta, Georgia. Co-author of Investing the Templeton Way, the market-beating strategies of value investing's legendary bargain hunter in 2008 as well. Lauren, welcome to the podcast.
Oh, thank you for having me, Caitlin.
I do want to get started with, for those who haven't heard of you, haven't had you on other shows before, can you just provide, I know I did give a bit of a brief background, but despite having the Templeton name, you also still had to fall in love with investing on your own. So what was it for you and what got you started originally?
Yeah, my father got me started in investing. He had decided that he had to work way too hard to make money as a small business owner in our town of Winchester, Tennessee, when I was growing up. And he and my mom decided early on to save 50% of everything they made and to study investing on the side. And they're both really smart. They did that very well. They both sat for the CFA examination. My mom went back to school after she was retired to study accounting. She's not an accountant because she doesn't have the work experience, but she made one of the top grades on the accounting exam in the nation. So they were both very dedicated about learning about investments, and they spent a great deal of time doing that when I was a child. And of course, that passion for learning and investing was passed on to me. My dad made it very fun. So every month I was allowed to pick one stock, and he would buy me a share of any company that I wanted. And he would hang the stock certificate on the walls of my room, and we would watch Wall Street Week with Louis Rukeyser at night when it came on. I think it was on Friday nights, if I'm correct. But it was just a lot of fun to learn about investing, and he made it accessible to a child by teaching me about companies. If I owned Walmart, he would take me down to the local Walmart. We would talk about everything I saw and whether or not that might translate into a profitable business. He talked a lot about opportunity cost and decision making and how everything in life had an opportunity cost. So if I wanted to buy something for $50 today, what type of money I was foregoing by not saving that $50 and investing it in the market. So that was sort of my childhood. It's just the environment I grew up in. And it was a lot of fun.
Well, I love that. First of all, start them young, right? I'm a huge proponent of that. Do you happen to remember the first stock that you bought by any chance, or one of the first?
I really don't. Some of the stock certificates that I remember on the walls of my room when I was a child course, Walmart, Disney. I had some shares of Shoney's, which was a restaurant. I don't know if you guys remember Shoney's, and that was really a great stock to own. It was a terrible business, but at one point I had one share, and it was trading for, I don't know, $1 or $2. I mean, it was not a great business, but its annual dividend every year, they would give you a gift certificate for a free meal at Shoney's, and Shoney's had these incredible strawberry pies.
Oh.
And so as a kid, I could take my gift certificate to the local Shoney's and order whatever I wanted to eat and have some strawberry pie for dessert. So I remember that one quite well. There were the Gap, things like that. So it was really the Peter Lynch style of investing almost. Something that was recognizable to me is what I wanted to buy, and Dad never questioned me about it. He didn't really push too hard on the concepts of, valuation metrics, et cetera, because I was quite young. He really just wanted to teach me to save and invest by buying a share of a business. So those were the lessons, and I think they worked well.
I would say so. And I think it's really important, right? When you're starting out, especially teaching younger folks about the market, not to make it more welcoming, right? To not make it too overwhelming. And like you said, I mean, you weren't focused on trying to build out some sort of DCF model, right? You were just learning the basics of what to look for in a sustainable business and something that you might want to invest in for the future too. So I do love that. Sort of shifting gears here. I know we talked about this a bit offline or with Bobby as well, but this podcast all around highlighting women in finance, I guess that goes with the name. And as you know, women traditionally always facing a bit of a steeper climb to the top, working twice as hard, whatever people want to say about there. I'm sure we can both a bit attest to that, but you've arguably, not to put words in your mouth, have likely maybe had to face an even steeper climb, one being a woman in finance. And your incredible relationship with Sir John and your father, kind of carving your own path outside of that. What has that experience been like for you?
Well, I mean, I think like everything in life, there are pros and cons. It's been an incredible experience. It'd be hard to go back and decide to relive it because it has been painful as well. I have worked really hard. I do think it's been challenging raising capital as a female, not necessarily running the business or learning about investing, but raising capital, I think, is a lot more challenging as a female. I also think when I first started, I was quite young. I was 24 years old, and I was the coach's kid. And it's not always fun to be the coach's kid. And in my particular situation, I started a fund with Sir John in 2001, and he passed away, I believe, in 2008. I'd have to look that up. But I think he passed before my daughter was born. So in 2008, so I didn't have a really long time managing money with him. And being the coach's kid, it was a unique situation when he passed away. It's very competitive. He had many other managers. So it was definitely hard and challenging.
Would you, and I guess you kind of alluded to this, but even after his passing, right? Like having worked with him for over a handful of years there, the transition to not working with him and the maybe adversities faced, kind of like you said, raising capital was difficult. Did you notice a stark difference with not, like, I almost hate to say it, but just harsh realities of things where it's like, sometimes you don't have that male presence or something when you're going out to raise capital. Did you notice a stark contrast in the way that, relationships worked within the business after that?
Yeah, I definitely would say that I did notice that. Now, another unique aspect about my business is that I work with my husband. So there is, I own the business. I am a female. I'm the portfolio manager, but there is a strong male presence in the audience here in the office. And it's interesting. We have meetings that we go into where I know I need to step back and play a secondary role because of the person we're meeting with. and let Scott do all the talking. And it's just it's interesting. And then there's some meetings where I know I can go in and be myself and talk. So it just depends on who you're meeting with, really.
No, and that makes sense, right? I guess kind of know your audience and have to adjust from there. But reflecting on the experiences that you've had so far, what have been some of, maybe kind of a cookie cutter question, but some of the best lessons learned, working through the business and in the years past, investing wise, at least, or otherwise?
The investing lessons?
Yes.
We are diehard value investors. And so really, to me, the main lesson, which is also the most basic, is that the largest rewards are going to come when you're putting capital to work during moments of maximum pessimism. So anytime there's a crisis or a large market sell-off, a bear market, any type of crisis event, that's really when you're going to do the best. And that will influence your returns for years to come. And most people do understand that as investors, but they are unable to implement it. So I think just being in the industry for so long and pursuing that course of action and being rewarded for that has taught me to look forward to market sell-offs, crisis events, bouts of maximum pessimism, as they say. That is what I've learned to look forward to.
Love it. And going back to, you're the Templeton way, kind of being grounded in value investing principles and whatnot. Maybe it's just me being on Twitter too often, but I feel like general population in more recent years love to rip on value investors. I feel like we're also caught up in the flashiness of growth and tech and whatnot, but let's talk about value, right? Like I guess kind of your outlook on the space, why such a high emphasis on value? I know that's been like kind of steeply grounded in investment principles for a very long time. And I know it's a big, great debate, right? Growth versus value, but rarely do we focus on the value side of that these days. Maybe it's just me kind of being more on the growth side of things in my work and my personal preference, but I'd love to hear your takes just coming from a value perspective on that, because I feel like in general circles, at least for those who aren't as deep in on one side or the other, we don't really talk about value as much these days.
Well, I think that's because value has underperformed growth. So that's why value is not discussed as much. And growth has been the big performer. And so that's where all the attention goes. But I would argue that because growth has outperformed value, now would be a good time to take a look at your investment methodologies and adjusting them. I like value investing because it works well with my personality type. I always tell investors, you've got to find what works for you, what works for your psychological makeup, and pursue that. And that's different for every person. But I have found that the discipline of value investing is something that I need. I like having a very disciplined approach to the investment process. I think it keeps me on track. It allows me to maintain conviction in positions during a market sell-off. It gives me the conviction to go in and put capital at work during points of maximum pessimism. And because it's so difficult to go against the crowd and pursue that course of action and buy when you really should be buying, it is very helpful to have a discipline around your investment methodology. I just find it incredibly helpful. And so maybe growth investors have a discipline around their process. I just don't see that it is as strict of a discipline, I should say. And so I know that I need something to really anchor to. The discipline of value investing helps me execute the strategy better.
No, it makes sense to me. And I can kind of understand that, like, having that process in place and everything, right? So going back on kind of the financial education side of things, financial literacy in relation to value investing, have you found that teaching the basic principles of value investing, which have been around for a very long time now, as you've talked about too, right? Have you found that to become more difficult in relation to, as you said, growth very, very much outperforming value? Is it kind of falling on deaf ears when you try to educate people on value investing?
No, I don't think so. In fact, I think it's the most common sense approach to investing. So it's the easiest place to start. When you talk about buying a business, right, and wanting it to be a profitable business and to buy it at a discount, that's about as basic as you can make investing, right? So it goes back to the stock certificates hanging on my wall as a child. I do not look at the markets as a place to speculate or to gamble. I am buying a portfolio of businesses, and I need to be really happy with those businesses. We don't invest in industries or companies where there's really a binary outcome. We like well-run businesses, and we try to buy them at a discount. That is truly a very simple concept that I think, when you're talking about financial literacy and education, really is the best place to start. I think people get that immediately. I wish that stock certificates were still sent in the mail when you bought a security, because I think the concept of holding a certificate in your hand and thinking, yeah, I own part of that company. I'm an owner. This represents my ownership, is very powerful. And I'm not sure that people get it today when they go online to their brokerage account and just, click and buy a stock. I feel like it's not the same. But as far as financial literacy goes, I'm very focused on helping close the financial literacy gap. I have started a little page on Instagram and Twitter with a friend from the financial world. She works at Unum, which is the largest financial institution in the state of Tennessee, and her specialty is really fixed income securities. But what we feel called to do is to help close that financial literacy gap and teach all young people about investing, saving money, compound interest, delayed gratification, opportunity costs, all those wonderful concepts that my father taught me. And if you don't know about them when you're young, you really are disadvantaged. So these are very important concepts to teach to young people. And we're hoping to bring that word to all young people so that they may benefit from the same lessons my father taught me.
I love that. And I'm a huge proponent of, financial literacy and starting young. I'm pretty sure I saw research where kids can pick up financial concepts as early as 3 years old, right? So it's never too early to get started. I love what you said about, this actually getting the stock certificates in the mail, right? I think having everything more on the digital side of things almost makes it less, I don't know if interpersonal is the right word, right? But you get a sort of feeling, right? When you hold something in your hands, you have something physical to look at and you know that it's yours. Yeah. I think there's a lot to say about that. So it's interesting from that perspective. And then just on financial literacy in general, it's kind of difficult to figure out where to start, right? I know you sort of started on that, but do you start with like personal finance topics first, right? Like managing your own money and then segueing into investing and learning about companies? What's your specific approach there? Because it's such a big beast to tackle. And I think that a lot of people have a difficulty in deciding where to start when it comes to educating people on finances.
Yeah, I don't know that I've necessarily figured it out. Of course, the first concept that you want somebody to grasp is the concept of compound interest and how it truly is a magical concept, but the magic ingredient is time. And so as a young person, you have that. You have the advantage over everybody else because you are young. You don't have to invest as much capital and you don't have to have as good of a return. So really, it's an easy thing to do if you start young to build wealth, right? You have a much easier path ahead of you. And I think once a young person grasps that, then they realize, okay, So it is important to save money and delay gratification, because if I do this now, with just a small amount of money, it can really impact my life much later on. And I will have an advantage over everybody else simply because of my age. And I don't have to do the best job in the world. I don't have to get the highest returns in the market. I can just get average returns, and it's all going to work out. So I think that's a good place to start. And then after they've mastered compound interest and they know, okay, it's important for me to save, which of course is delaying gratification, you can introduce opportunity cost, and then, work with a young person to say, hey, there are lots of different styles of investing. You need to find one that resonates with you and your personality type. And I think they can start to pick up on the different styles of investing. And I actually think value investing is very compatible for somebody just starting out, right? Because it gives them a framework, a discipline. And it really makes sense to even a young child that, if you think something is worth $10 a share and you can buy it for $8 a share, that probably is a wise decision. So I think that's a good place to start, really, the concept of compound interest and how important time is as an ingredient in that equation.
Yeah, no, I agreed. And I think I liked the part on what you said with value investing being a good place for kind of newbies to start out, right? Because it's just something that makes sense. You have a disciplined approach. You can look at a company not knowing much about the financial markets and, do you think that this company is sustainable? Do you, it's just something that I think comes a little bit more intuitively to people, to people on the outside that don't have as much of background knowledge. So I do really like that.
I think so too. And then you can move into, if you wanted to move into just, personal finance and sort of financial planning, you can teach what reverse compound interest is and why credit cards are so dangerous and debt is so dangerous and how that can work against you as a young person. So here are how to stack the odds in your favor, and here's what you can do that can really put you in the hole for a long time. And I think just that right there could really impact somebody's life.
Absolutely. I think that's a perfect place to start, especially talking about debt and whatnot. I never talk about that enough to educate people there, but going into, we talk about value investing, having an approach that's very methodical and whatnot. Let's talk about the markets today, because I think in a lot of cases, it's quite the opposite of that right now in a lot of spaces. And, what are your views on the markets right now? I saw on your website, you literally have a quote that say, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. I feel like we're in a bit of a euphoria right now in a lot of different spaces, but I'd be curious to hear your takes on what we're seeing in the markets right now, because it's a lot to watch.
Obviously, we feel the same. We think it is a bit euphoric. My past experience over many years says that things can stay that way a lot longer than you think they can. The markets can persist and be irrational for much longer than you think they can. I have no idea what the market's going to do tomorrow or in 6 months. I know that in the US that things are pricey, and that, you can find better valuations in the emerging markets. Earlier this year, we were looking in the UK a lot. So we think things are a bit euphoric. It reminds me a lot of the tech boom. So I graduated from college in 1998. And so I was working at Morgan Stanley Dean Witter as a sales assistant during the .com boom or the .com mania. And that was a really interesting time because, everyone was talking about the new economy and how the internet was going to change the world. And of course, internet stocks soared. There was an IPO every day, a steak dinner every night. And during that time, I went to visit my uncle. I made the regrettable mistake of asking him what tech stocks he was buying. Of course, he was shorting tech stocks at the time, but he was very patient and he walked me through all the bubbles he had seen in his lifetime. And then he told me his strategy for shorting .com stocks at the time, which was he was shorting them about 7 days prior to their IPO lockup expiration. And it was covering about a week later. So he made gobs of money doing it. It was a very profitable strategy for him. And I do think the market today reminds me a bit of the .com crisis or the .com boom and bust. So that is very analogous, I think, to what's going on in today's market.
Yeah. And kind of along that vein, right? We see the sectors that are getting all of the love, right? But on the other end of that, from a value perspective, what sectors aren't getting any love today that you've been looking into, right? I mean, I think the areas of opportunity for a lot of people are what they are perceived as. It's a lot of, crypto, technology. It's similar in what you were just saying with like the tech boom, right? I think there's a lot of attention on companies of that nature, but what sectors aren't getting love today that that you would highlight?
Well, we certainly are not investing in crypto. So I will tell you that, I came into my office really quick because I have this great quote by Scott McNealy, who was the CEO of Sun Microsystems. And if you recall, Sun Microsystems at the peak of the .com mania was trading at over 10 times revenue. And after the .com bubble had burst, somebody asked him about that. And he gave a great quote that I keep in my office. It's actually taped to my wall. But he said, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. That assumes you pay no taxes on your dividends, which is kind of illegal. That assumes with zero research and development for 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 10 times revenue? Do you realize how ridiculous those basic assumptions are? You don't need any transparency and you don't need any footnotes. What are you thinking? Now, I love that quote because, and I come back to it in a lot of my presentations, because it really just emphasizes how important valuation can be and really the absurdity of what we're seeing in the market right now. And, as of, I think, maybe 3 weeks ago, we could count 759 companies in the United States trading at over 20 times sales, so 20 times revenue. And there, Scott McNealy is making that quote on 10 times revenue. So I do think that things are a little irrational right now. And that's just a really good example of why valuation will always matter and why it is so important what you pay for a company. Because, of course, a lot of people purchased stocks at the height of the .com boom. And one of the stocks was Microsoft. Microsoft has been a very profitable company, really a .com success story, if there ever was one, for many, many reasons. And if you had purchased shares of Microsoft during the height of the .com boom, you would have had to wait about 17 years to generate a positive return. So I do worry for people investing capital at these valuations today. And you do have to look a lot harder around the world to find pockets of valuation. It is extremely difficult to find well-run companies trading at a discount. So I think investors need to be very patient in today's market. And of course, that's always hard to do when everybody's out there making tons of money all around you. And it seems so easy. But really, in the later stages of a bull market like that, and you think about the Microsoft investors that invested in Microsoft in the late 1990s and having to wait 17 years to generate a positive return, I'm afraid that's what we're going to see coming out of this current market environment. So I would encourage everyone to be very patient and very selective. One of the reasons we like to focus on global investing is we just want the largest universe of stocks available to choose from. So if the US on average is very expensive and we can find pockets of valuation in other economies, we'll look there. But I think the more flexible you can be, the more open your investment policy is, and will allow you to look in different areas for bargains, the greater the likelihood that you will be able to find one is. But I do think today is an interesting time to be investing. The other quote that I have on my desk that I continually read is one from an economist named David Rosenberg. And I'm sure you guys have heard of David Rosenberg or may even follow him. I follow him on Twitter. But a few years ago, he said, I get asked repeatedly the statistic that troubles me the most, 13 million. That's the number of people who have joined the financial industry since the last credit collapse ended. These youngsters have only known bull markets and everything from weed to fangs to Picassos to crypto, uber low interest rates and endless quantitative easings and economic expansion. And are they ever in for the surprise of their lives? So when will it happen? I don't know. Things can really stay irrational for a lot longer than most people anticipate. I remember living in Atlanta, and I don't know exactly what year this was, but it was probably around 2004, 2005. And I was at a presentation. I don't even remember who was speaking, but I asked the presenter at the end of the presentation what he thought about a housing bubble. And everybody in the room turned around and looked at me like, oh my gosh, this girl is such an idiot. And it really embarrassed me. But I had, of course, been around John Templeton, who had called it well and knew that 2008 and 2009 would be right around the corner. And in fact, I'll have to go back and look at the date, or you could look it up as a listener. If you Google John Templeton Financial Chaos Memo, he penned a memo to me. It may have been in late 2004 called Financial Chaos. And the first line of the memo says, from here on out, like the peak of prosperity is over. And he goes on to detail the housing collapse and really the collapse of the financial system. It's kind of scary, dead on accurate. And of course, he died and didn't see any of that. So when I was living the great financial crisis, I thought about him daily and thought, oh my gosh, he was right about so many things and he never lived to see it. He was so early. And my point in saying that is, yes, that I think the market is a little irrational now. I think 759 companies in the US trading at over 20 times revenue is absurd. But when will it end? Who knows? Things can persist for a lot longer than you ever think they can.
Wow. Yeah. Isn't that the truth? Right. So, and I do have some questions coming off of that. That's, is really great insight, but just for context, I'm a Gen Z. I'm 23. I was 10 years old in 2008. So thinking about, a lot of these investors and the surge of the retail investor in the past year or two, or even the past decade, I don't know, but more specifically in the last year with COVID and whatnot, investors who have never seen a bear market, right? What do you think the implications of this are for the large number of investors that have never seen something like this? And like you said, I mean, maybe the market continues to surge upwards for a period of time that's longer than any of us could have guessed. But at some point, it's cyclical, right? At some point, we will see a pullback. At some point, we will see a lot of people really not knowing what to do. So I'd be curious, it's happened before and it'll inevitably happen again. What do you think the kind of reaction will be from all of these retail investors that have never seen a bear market when it inevitably comes?
Well, first, leading up to the bear market, you'll see excessive risk taking, which is what I would say we're seeing now. And that has to do with the inexperience of investors, but also, that has all been created by our wonderful low interest rate environment and the search for yield. People have really taken on a lot of risk. I think when the market eventually does correct and there are a lot of inexperienced investors in the market, they're going to rely on social proofing. So they're not going to have a lot of conviction in the names they own. In many cases, they may not have researched the companies very well themselves. And so social proofing is a concept in behavioral finance or psychology where people will look to others to see what to do. And that creates these big sell-offs in the market. So the way I like to visualize that is before Waze or Google Maps and you were sitting on an interstate and there's a traffic jam and you see the person in front of you getting off at an exit and then somebody else follows them and then somebody else follows them and you're sitting there thinking, wait, what do they know that I don't know? Maybe I'll get off at that exit too. There's a shortcut. There's a different way around the wreck. That's a really good way of visualizing social proofing. And it really happens in the markets every day, which is why I am a proponent of value investing, because that is the human tendency to do that. I mean, everybody is going to have that tendency. So what mechanisms do you need to put in place to prevent that behavior? And for me, the mechanism is the discipline around value investing. I need that discipline to create the conviction to stand pat during a market correction. And then we implement other tools here in the office to help us put capital at work during those corrections. Now, of course, I've been doing this for many years, and these events in the market are not upsetting to me. I actually look forward to them. So my philosophy has changed over the years. Like, I don't need as many of these guardrails anymore. I just know to do it, and I know that I'll be rewarded when I do it. And, I'm not a complex person. Consider me a, rat that learns to go for the cheese or whatever, Pavlov's dog. I anticipate the reward when I put capital to work during moments of maximum pessimism. But I do think, the inexperienced investor in the market who's just been rewarded over and over again and hasn't lived through a really scary event and hasn't really earned their stripes, they will rely on social proofing, which will contribute to the market sell-off. And of course, you end up selling at the bottom, which is one of the worst things you can do. One of my first investments that I made with a sizable amount of money was after I graduated from college, and I borrowed some money from my father, and I invested it, and I lost a good bit of it. And I called him with the news and said, I am so sorry. I was so upset about it. And he said, great. This is exactly what I wanted to happen. And I said, what are you talking about? Like, I've borrowed this huge amount of money from you. I have invested it. I've lost it. How could this be what you wanted? And he said, well, it was cheaper than grad school, and this is the best lesson you could have ever learned. I'd gotten a sort of a hot tip from somebody and decided, this is a company that I wanted to invest in. I didn't do my research. And, that perspective of, you've got to do your research. You've got to do your own work. The market is not a casino. You cannot gamble. I think all of that was an important lesson. It also tells you a lot about my dad and the way he thinks about risk taking and teaching your kids about investing. Now, of course, I'd been investing for many years, but a share here, a share there. This was the first time I had done it with sizable capital, and it was borrowed from my father.
Wow. Well, first of all, that's a great story. And I think it's one thing that's often lost. And I feel kind of silly saying like on younger investors, I'm a younger investor, but we so often forget like the power of losing and how powerful that the lessons learned from losing are, right? And like you said, I mean, there is so many people who haven't experienced that feeling yet, right? And they have a hard lesson coming, but it'll probably be one of the best they've ever had. So couldn't agree more on that. And I love the part where you said that you kind of look forward to those pullbacks, right? I'd be curious to hear a little bit more there, just because I think some people are fearful of that. I think that others see it as a big opportunity. And I'm kind of assuming that that's where your kind of thought process is on the latter of that, but would be curious to hear more details there.
Yeah, I mean, that is exactly the way we see it. It's an opportunity. It's a golden gift. And if I don't have a lot of those opportunities, it's really hard for me to outperform the next guy. So there are a variety of ways to make money in the market. When I'm counseling friends or clients about how they should evaluate a manager, I always say you need to figure out how they make their money. And I don't mean growth versus value, what models they're running. Like, look at their return pattern and tell me how they're outperforming the market over a long period of time. Are they outperforming the market because in a bull market, they can outperform every year? Or are they keeping up with the market and they're not drawing down as much in a bear market, right? So there are different ways to outperform over the long run. And I always say to people, you need to figure out which type of manager you're hiring, because there's a time and place for all of them. Like right now, with the market being as pricey as it is, I would argue now's the time to invest with an investment manager who has a long-term track record of outperforming in the market, but a lot of that return comes from periods where they just haven't drawn down as much as the market. So, and at the bottom of the market, you would want to switch to an investment manager who has the opposite profile. But I guess that kind of, we got off track there, but I do think that market sell-offs are my opportunity. And without them, I have a hard time outperforming other investment managers because the way my strategy works, that's just, a golden opportunity for me as a market sell-off. I know that will impact my returns for years to come. After I had my first child in 2009, and you may have heard other interviews with me where we were literally buying stocks in the delivery room during the sell-off. She was born on March 10th, 2009. And of course, the lows of the market were, I believe, March 9th, 2009. So we were buying at the bottom of the market. We were in the delivery room. And the nurse came in and told my husband, you need to turn off the computer now. Like, now's the big moment. And I was like, did you get the order filled? So that was my perspective. Now, did I know it was the bottom of the market? I absolutely did not. And we had been buying for months up until that date. I just knew that the stocks were so ridiculously cheap that we needed to get those orders executed. And then a month or two later, we went on CNBC and we were at up in New York at 30 Rockefeller. And I remember saying, I'm hoping my daughter is ushering in the next new bull market. And everybody kind of looked at me like I was crazy, but look, it's been the longest running bull market. and her birth date really was the first day of the longest running bull market in history. But my point is, those orders that were filled on that date and the months leading up to it, man, they really boosted our returns for years to come after the great financial crisis. So my investment strategy is very reliant on these events. And that is because, it is, you'll hear other people say it, but there are really only 3 sources of alpha available to investors in the market. So you can have better information, which is very difficult in today's market, right? And you've got to stay away from inside information, all of that stuff. That's a very hard strategy to implement, I would say. You could have a better model, and, we don't really operate in that space. Or you can have better behavior. And that is where I am. And that's what I think my advantage is. So that is why I am very compatible with value investing. I think human behavior always is, the way it is. And if you can learn to control yours and use it to your advantage, then you have a strategic advantage over everybody else in the market. And that's really the space we play in.
Wow. To all of that, first of all, do want to emphasize the last part of what you just said, which is not throwing away emotion, right? It's harnessing it. It's kind of implementing that within your practice and knowing how to control it. I think in how to work with that is super, super important. But let's just back up a little bit and kind of celebrate the fact that you were literally doing trades in the delivery room. I've never heard that story before. That is incredible.
It wasn't that big of a deal. I mean, we just
awesome,
yeah. I mean, I will remember it. The nurse was really confused by it. And I think she thought that my husband was being very neglectful. And she didn't realize that I wanted him to do it. So it wasn't like, oh my gosh, he's doing this. I was like, please get those orders in. Anyway, yeah, it was an unusual delivery, I guess.
Wow. Well, yeah, memorable is right on that. You will never be forgetting that.
Yeah.
But it is time to sort of wrap up here. I feel like we could talk about this all day because you just have story after story and they're unbelievable. So thank you for all of that. I always end with the same question. I think Bobby told you about this beforehand, but I'm a big proponent of getting outside to unwind, but we'll not discriminate against my guests here. I just like to ask, always talking to mostly women, at least, that are like very, very much in high positions, doing awesome things, kicking ass. But what do you do outside of that? Everyone has a life outside of that. So I would assume. And I know you mentioned your daughter, but what do you like to do to kind of unwind outside of the, the value investing biz?
Yeah, I do a lot of things, and I really like to be outside. This morning before work, I went for a walk. I lifted weights. I play tennis a lot. Hike, trail run, a lot of hiking. We live on a mountain in Tennessee, and I can walk out my back door and be on a trail within 2 minutes, and in a beautiful trail as well, running along the edge of the mountain. So we do a lot of that. And then my youngest daughter is really into horseback riding. So she's hunter jumper. And I spend a lot of time sitting down at the barn. So I'm, mucking stalls or feeding horses, just sitting there watching her ride. I don't ride anymore. I mean, I can ride, I just don't. So I find that that's really valuable. I'll take reports down to the barn, sit out on the chair and read, or, put on my boots and go help out with the horses. But that time outside, I just love it. I love trail running. Actually, trail run with both of my girls, which is so fun to see them do it right next to me, to like look over and see your daughter and she's running on a trail next to you. That is really fun. I like to do that alone too, to give some headspace and time to think. But my grandmother on my mom's side, she always said, anytime you're stressed out, take your shoes off, go stand in the grass and look up at the sky. And I think there is a lot to be said for that. And being outside is really important to me. You'll hear a lot of investors talk about different things they do and incorporate things in their schedule to find some peace. John Templeton always left the office around lunchtime, and he went to walk every day in the surf outside of his home at Lyford Key. He even had his dress shirts hemmed so that, it was not the shirts that he would wear to work, but he had a little dress shirt and it was hemmed so that it would stay dry. The water wouldn't hit it. But, the sun is very powerful in the Bahamas and he had to be careful for skin cancer. But he would go out and walk in the surf for an hour. And there's a legendary story of him doing that during the 87 crisis, just getting up and walking out. And everybody was like, oh my gosh, where did he go? Does he not know what's going on in the market? And he came back from his exercise and they were like, John, do you not see what's going on? It's a huge crash. And he said, sit down, boys. I've got good news and bad news. The bad news is we're in a bear market. The good news is it's almost over. Please have your recommendations on my desk by the end of today. And I've spoken in great detail to the brokers that he kept on the line all day long just to place orders. And he said, this will make my returns for years to come. And he was right. So stories like that played a big role in my formation as an investor. That's our perspective on the market. And being outdoors is just a fun and peaceful way to organize your thoughts.
Couldn't agree more there. Everyone listening, get outside, touch some grass. It is literally the most helpful thing you can do, is even if it's for 5-10 minutes, right? So thank you for that. We are in agreement there. But I do want to thank you so much again for being on the podcast. This was incredible. I feel like we could do this again sometime easily. But do want to give you a chance to let everyone who is listening know where to find you and to keep up with you on social media with all of your musings.
So I'm on Twitter at LC Templeton, and I actually don't know my other handles. TempletonandPhillips.com is our website. We have a newsletter called the Maximum Pessimism Report that's available for free. It's periodic. We have a YouTube channel, Templeton and Phillips YouTube channel, so you can go there and listen to some podcasts and see some presentations on that channel. And that's about it.
Awesome. Well, Lauren, thank you so much again. Thank you to everyone for listening, and we will be back next week with another episode.
Okay, thanks so much. Bye-bye.